All right, welcome. Let's continue from where we left off in terms of the consolidated statement of profit and loss account. Okay, so let's launch straight to where we left off. Um, okay, all right, here we are. Okay, so we got to this point. I want to take you one step back again. We got to this point. I want to take you one step back again. So, like we said, don't be tempted. Okay, don't be tempted. Once you get to this level, you want to just apply 25% of it. Okay, to get your NCI portion. Assuming you find 25% of 145, 400, you end up getting 36, 350. Okay, now compare this to what we actually have, 13,500. That is way off, way off. Okay, so don't be careful once you get to this level. Don't make life easy. Life is not that easy. Sometimes, if you wanted to get the NCI portion for this total portion, we've already calculated it's 13,750. Use that one. Don't be tempted to find 0.25, 25% of this 148,900. Then you end up getting some 37,225, which is a total misrepresentation of the portion that is attributable to the NCI. Okay, now let's move on. Assuming that we acquired this company mid-year, not at the beginning of the year, what happens? Okay, what happens? Mid-year acquisitions. Okay, the statement of profit and loss. What do we do? Okay, what do we do? Now, when combining subsidiary performance, you must only include the post-acquisition revenue and expenses only. So I acquired this. The company was already in existence. So this company, let's say the year end is 31st December, right? So he's starting from 1st January to 31st, and then sometime 30th June, I come in to acquire the company. I must only consider the post-acquisition revenue and reserves after the date of acquisition. Okay, because we didn't acquire it from the beginning. Okay, once we have that notion in mind, we should always assume revenue and expenses will accrue evenly, unless clearly stated in the question. Okay, but usually it will be assumed to accrue evenly. Okay, where dividends have been received from the subsidiary in the post acquisition period, we must remove them from the group investment income. Remove them. The same story we've had in the previous section that we looked at. Okay, dividends in the pre-acquisition will actually be incorporated in the net asset at acquisition. Okay, any dividend that we might have benefited as a group, as a parent, will be incorporated when we are calculating the net assets at acquisition. All right, let's move on. So once again, the procedure, the next thing is that any intra-group trading, such as trading, what do? We must remove them, of course, but be careful. You need to prorate. Look at it carefully. So take care only to exclude the post-acquisition element. Okay. So take an example. You understand. What about the usual adjustment, the POP, the fair value depreciation, the impairment? What do we do? Once again, I'll go with the easiest one, the impairment. Everything is gone off. Everything. Because we are talking about the parent's portion or interest in the subsidiary that is impaired. No timeline there. Recognize everything. Okay, subtract everything. Okay, the POP. We need to look at period end adjustment. Okay, so here we again recognize everything in full. Everything in full. Okay, but only for the fair value depreciation, especially as depreciation is not calculated midway, it's calculated for the whole period. We need to use time apportionment and prorate accordingly. Okay, so whatever we get in terms of depreciation, prorate it depending on the number of months we have or acquired. We acquired it within the period of reporting, and again at the end of the day, we then split the total profits between the parent and then the NCI. If there's any total comprehensive income, let's add it. Then the total comprehensive income TCI that we get, we split it between the parent and the NCI. Okay. And here we must also take care that with NCI, we only include post-acquisition elements. Let's take an example. Okay, let's take an example. So after this, we end. This is quite straightforward. Okay, so on 1st April, Lobster purchased 80%. So NCI's portion is 20%, right? In crab, the summarized statement of statement of profit or loss for the two entities is out as 31st December. Okay, so now look at it. The year end is 31st December, but we entered into this kind of investment with this company on 1st April. That's 9 months. 1st April to 31st December is 9 months, right? So remember, in terms of any pro rata, it will be 9 over 12. That's whatever I want to do, okay? All right, revenue, cost of sales, gross profit given, operating expenses, finance cost, profit before tax, income tax expense, profit for the year. No other elements of other comprehensive income. So at the end of the day, when we get here, we end it and find a portion that is attributable to the NCI. All right, let's move on. Okay, so I hope this straightforward. The figures are there. Okay, same in the slides. That's why I'm moving fast on this particular page. Okay, all right. Now let's look at the footnote. They said during the year, CRAB, the subsidiary, okay, sold goods to the parent for 10,000 at a margin of 30%. Okay, 40% 40% of these had been sold by Lobster. So it means there's 60%, okay, of the pop that we need to recognize. Okay, 40% are the pop that we need to recognize. Okay, we move on to say at the date of acquisition, all of Kraft's assets were valued with the exception of an item of plant which has 15,000 above its carrying amount. At this point, the plant had a remaining useful life of 5 years. Okay, so again, we have our 15, right, divided by 5, right? Okay, that's a depreciation element. Okay, typically you would have just had your 3,000. Am I correct? Yes. But remember, depreciation for the whole year, we need to prorate. Okay, I will not write, so I just say to prorate. Okay, that's a prorated element. Okay, the 9 over 12. Okay, Lobster's policy is to value NCI of Crab at the date of acquisition. Impairment of Crab suffered impairment. The goodwill of Crab suffered an impairment of 3,000. This goes fully, okay, to who? To the parent. All right. Now prepare a consolidated statement of profit or loss of the group of Lobster for the year ended 31st. Okay. All right. Let's look at the calculation. So you realize that how much is left? We had 60%. Okay. We were told that there is a margin. This is not a markup. This is a direct one, margin. So margin, more or less like a profit, the return. Okay. So what we are saying is that, listen, we had 30%. That margin of these 10,000. Assuming they had not sold everything, we would have kept it. Okay, we would have gotten 30% of 10,000, which would be what? 3,000. And we knock it off. But we're told that 40 has gone out. Therefore, the 60 is what we need to now get rid from our books. So the 60% of that 30% margin gives us 1,800. 1,800. Okay. All right. But remember, how much did we sell? It's 10,000. We need this for our calculation. Whenever we are dealing with the revenue and cost of sales, okay, we need this for our calculation. All right, then the fair value at depreciation, I think I mentioned it would have been 3,000, but the prorated portion, okay, which is 9 over 12, gives us 250. You prorate it. Here, we don't prorate for the pop. Same applies to impairment. We don't. Okay, all right. So Crab's profit for the year, the profit for Crab for the year is 13,000. But it's for the whole year. And we acquired this midway. So we need to prorate once again. Okay, we need to prorate. That's a portion, the post-acquisition element we need. Okay, so we have the prorata portion of the 13,000 gives us profit of the subsidiary we are entitled to. Okay, which we are entitled to. Okay, then the pop element, which we have found 1,800, we subtract it. And then the same thing we have done in the past, fair value depreciation, 250, we subtract it. I'm sure you know the mechanics for all of these. The main thing is to be able to understand these calculations and work them out accordingly, all right? So we less the impairment. Everything, okay, remember, it is the impairment fully attributable to the parent. The parent is suffering all these impairments. So everything, regardless of the timeline, okay, even if it was 1 day to the end of the year and he suffered that impairment, everything should be charged. Don't prorate it, okay? All right. So we get this as the adjusted profit for the year. NCI will now take what 20% because he holds 20% shares of the 2,700 and he gets 540. 540. Any other profit that we have is attributable to who? The parent. Goes to the parent. So when we prepare our consolidated financial statement, this is what? The parent revenue, subsidiaries revenue minus the 10 that I asked you to note, the trading element, okay, that we gave to we sold, that the subsidiary sold to the parent, okay. All right. Again, the cost of sales, parent, okay, plus that of subsidiary minus the 10 again. The same leg comes here, okay. You knock it off from the revenue, you knock it off from the cost of sales to get the real picture, okay. All right. Now we going to find our unrealized profit, 1.8 or 1,800, okay, and then that of the depreciation, fair value depreciation, 2,250, okay, 2,250. I'm holding them in thousands. That's why I just kept it 2,250, okay. So this 10,000, this 1,800 is 2,250, okay, and then we get this figure. Subtract, we get our gross profit, and as usual, operating expenses. Operating expenses. So we have that of the parent, that of the subsidiary, and this is the impairment. The 3,000 is the impairment portion, okay? Included in operating expenses, unless you've otherwise stated that you should include it in cost of sales, then you can send it there. All right. Finance cost, just the two elements, add them. We get profit before tax, okay? We know subtract. We sum this up, subtract it from these, and we get these elements. Okay, 659, 100. Income tax expense, don't worry your head, add up what we have in the books, okay? We get 14,400. Profit for the year is this, 44,700. Already, we have calculated that attributable to the NCI, which is what? 540. And the difference between the 540, okay, and the 44,700 gives us 44,160 attributable to the parent, the owners. Okay, that is it. Very easy, okay. Normally, you come across this question in an exams, and you can actually score 100. In fact, you need to score 100% of this if you see it as part of a question, a sub question. And because of its ease of calculation, we normally don't assign much marks, but it's fairly represented, okay? It's fairly presented, okay. I'm going to end here, and I'll entreat you to take your TYU, the core text, try and see if you can attempt these questions 1, 2, 4, and 5 from chapter 19 of the ACCA financial reporting text. Solutions are within. Take your time and study it, okay? Again, for further understanding, for in-depth understanding, look at the whole chapter 19 of the text, of the core text, okay? Again, I'll say consolidation is very practical. All you need to do is to work more, practice, okay? More practice gives you a foothold, a hands-on approach on whatever you're doing, okay? I've also populated this. I think I've had the assumption that we all have the exam kit, but it's not true. Some of us don't have the exam kit. So what I'll do is that I will include 2 out of these in the tutorial, okay? 2 in the tutorial. The rest take the same pattern, okay? 2 in the tutorial questions, okay? Maybe I will modify the figures slightly. Okay, I'll modify the figures slightly so that anyone who has worked, who has the exam kit and has practiced it, should be able to understand this. And even if you don't have the practice kit, you should get a fair understanding of what is happening. Okay, so friends, I'll end here. Good for this one. We are within 15 minutes. So I'll leave it here. And then the next section, we'll be looking at associates. If that video also extends, I'll break it down into 2. I don't want to go beyond 25, 30 minutes, after which we will look at the disposal. All right. See you, friends. Take care. Bye for now.